Right. Well, I don't know how many there of you gathered here or listening in, so let's begin. First of all, I'm Craig Moss, and I'm joined here by a fellow colleague of mine, tax expert called James Calverley. Say hello, James.
Hello, James.
No, you're meant to. Okay, carry on. So here's an overview of what we're going to cover in our fairly brief webinar today, which will be roughly about 45 minutes long, and we're going to give you hopefully about 15 minutes for questions. So we'll give some introductions to myself and James. We'll keep that fairly brief. We'll also be covering a review of the budget that was announced in March, and as you know, most of these are announced regularly. So we're going to look at the impact on that and how the contractors affected. And I think most of you listening in are contractors of some type, whether you've been doing it for 6 months or 6 years. The new budget will affect you, and we'll hopefully cover that in layman's terms so you can understand. We try not to chuck too much jargon at you. The other area we'll look at, of course, is the new SDC rules, supervision, direction and control. And for those puzzled as to what we're talking about, we will explain, I promise you. And obviously we will look at how they affect the entitlement to travel and subsistence costs. And again, all will be revealed later. Then we'll look at those with limited companies, and some of you, in fact, I would say a majority of you listening have a limited company and will now be affected by the new dividend regime. And that also affects those that own their own business, so larger, medium to large size corporations. And then we'll also look at stamp duty. Some of you own properties, some of you own 2 or 3. Well, got bad news for you. Stamp duty has gone up, so we'll be looking at how you're affected in the budget, especially on second homes. And then we'll also look at the loan structures. Some of you have attended seminars that have used a salary and a loan. We'll look at some of the changes, especially those on the loan solutions where legislation will come into play in April 2019. And finally, and I look at this is probably the more positive side, we'll also look at ways and explore ways contract workers can be remunerated from April this year, and more importantly, compliantly and as tax efficiently as possible. Unfortunately, some structures out there are less tax efficient, and again, we'll allow for questions and answers at the very end. And I would ask you to listen, make notes, and think about questions you want to ask, and send those questions through to Randy, who will field those questions, and we'll try and deal with those at the very end. So here's me, very brief overview of myself. I've been in recruitment and employment for 30 years, so I've been working with contractors for quite a long time. I was an IT recruiter in California for 7 years. So I'm very familiar with some of the technology that's out there, probably a little bit outdated in terms of my experience, but I am very familiar with the needs of contracts, especially in the IT area. Origin Wealth isn't just providing solutions, we also work with a number of partners who provide anything to do with tax. So that's payment solutions as well as anything associated with tax and tax planning. And obviously, like any introductory service, we provide fees. So that's a little bit about me. I'm going to hand over to James Calverley, who will tell you a little bit about him.
Okay, thank you, Craig. My name is James Calverley. I'm qualified under the Association of Taxation Technicians, which is basically a qualification in tax. Over the years, I've worked for many accountancy firms, starting with the Inland Revenue, moving over into the accountancy world, into PricewaterhouseCoopers, Deloitte Touche and Grant Thornton. Now working for TT Intelligence, where I'm assisting freelancers, landlords, high net worth individuals, businesses generally with tax planning. Also assist my clients with if and when they get tax inquiries. Essentially, somebody's got to try and keep the taxman at bay. Essentially, the taxman is crossing the line frequently and breaking their own rules, so someone's got to keep them in check. And as mentioned there, we offer a variety of tax planning solutions which are all bespoke to our clients' individual circumstances.
Okay, now I'm going to hand over to James, although you've just heard him speak. I'm going to let him deal with some of the nuances of the budget. So you're going to hear his voice, and I might interject from time to time. Is that okay, James?
Well, you did on the dry run. So
okay,
yes.
Fair enough. Okay, so James is going to run through the budget. And again, please make notes and get your questions ready.
Okay, so the sort of main topic of the conversation is the budget update for contractors. The things that were really relevant to contractors in the budget was the introduction or the update of the SDC rules and how they affect the entitlement to travel and subsistence costs being paid tax-free to contractors. There was also announcements about plans to change the IR35 rules in respect of workers who work in the public sectors. There was also changes to the dividend taxation regime, which had been pre-announced. Surprisingly, we got a change to the director's loan account regime as well. The tax rate has been increased on that. As lots of contractors are personal service companies as well, they often pay themselves a small salary and maybe take the rest as dividends. So the revenue also introduced this start savings rate some years ago and have now introduced an additional personal savings allowance. So I'll talk about how that works. There's also some new anti-avoidance rules when you come to close down companies. A lot of people have been seeing, what's been going on in the sort of contractor world and start to close their companies. There's some pitfalls to watch out for there. And as Craig mentioned, some of you may well be landlords, and there's been an awful lot of changes there. So I'm just going to go through that. And then I'll just very briefly skim over some of the other main points that came out of the budget. There you go, move on. Thank you. So if we start with the new SDC rules, these have been introduced from the 6th of April 2016 for anyone providing their services through an intermediary. So what is supervision, direction, and control? It is exactly that. Are you supervised, directed, and controlled in the way that you work or the way you perform your duties? HMRC published some detailed guidance a couple of weeks ago on the 27th of April. It's made it clear that it is the how you are supervised, directed, and controlled, not the what, where, and when. The how, what, where, and when effectively are the sort of four legs of the control test that many of you who are familiar with IR35 may already know about. But the new SDC rules are not just whether someone does have supervision, direction, control over you, it's whether they have the right to supervision, direction, and control over you. And this is not just imposed by your contract, it could also be imposed by an agency contract if you're working through an agency and through your actual working practices. So you have to take a step back and look at the whole picture. These new rules affect personal service company, umbrellas, and recruitment agencies, in fact any intermediary, but they are the main categories. And if you are providing your services through any of these, then from the 6th of April 2016, supervision, direction, control is assumed. The onus to prove otherwise is with either the intermediary or the worker themselves. And if you can't demonstrate that there is no SDC, then the new rules operate to restrict the availability of tax relief for travel and subsistence costs. And it is the payer, the person who makes the payment of the worker, who is affected. They cannot make the payment to the worker tax-free. So if you're working through an agency, the agency can no longer pay you tax-free travel and subsistence. Or if you're working through your own personal service company, although your company will invoice for your travel and subsistence and can receive that tax-free, you, when it is passed on to you, you cannot claim that as an allowable tax deduction, and you can't have it tax-free in your hands either. So it's fairly fundamental change. HMRC guidance has said that if they come along and have a look at this, they will look at all of the parties involved with the worker. So not just the actual worker, not just the contract. They will go in there and they'll talk to other managers in the department, other workers in the department, and quiz them as to exactly what's going on. So the level of proof that's going to be required to show there's no SDC is rather great. Some umbrella companies have started to implement simple checklists for the worker to complete periodically. This is not going to be sufficient.
It's a bit of a minefield, I think, as well, James, as to how clear that's going to be handled. And I think every agency, I think especially the larger ones, the recruitment agencies, bigger corporations will have more red tape.
Oh, absolutely, absolutely. So what is the problem? What's changed? Well, traditionally, a worker who works through an intermediary can categorise where they're working as what's called a temporary workplace. This is essentially somewhere where you work for less than 24 months, or if you go over 24 months, less than 40% of your time. Now, the new SDC rules mean that if there's SDC, which is assumed, then each assignment that you work for through that intermediary is treated as separate employment. And if it's a separate employment, you simply can't have a temporary workplace that you attend regularly. You would have to actually go into different client sites every day, more or less, in order to still qualify for those travel and subsistence payments and for it to be a temporary workplace. Personal service companies we originally thought were going to be as fully hit as I'm describing now, but fortunately when the legislation came through, it actually said that personal service companies only need to consider this if they're caught by IR35. Now, under IR35 previously, if you're caught, you would have to work out a deemed payment at the end of the tax year, and that would have to go through the payroll after various adjustments, including a deduction for your travel and subsistence cost and 5%, and then that would have to be exposed to payroll taxes, tax and national insurance. However, realistically, under the new rules, if you are caught by IR35, it's going to be almost impossible to show that there is no SDC. So if you're caught by IR35, then there is going to be no further relief for travel and subsistence costs, which will significantly increase the deemed payment. So the IR35 tests consider status, the status of the worker. So if you took away the personal service company, how would that worker be viewed? Would they be viewed as an employee or self-employed? There's three main factors that the courts and the revenue look at when they consider this. Is there personal service? Is there control, of which SDC is just one leg? And is there mutuality of obligations? Those are the three main legs. And if you could knock out one of those legs, then traditionally you've not been caught by IR35. So that's why everybody put in substitution clauses into their contract. The revenue are making clear now that that's not going to be sufficient. So they are tightening up the IR35 rules in addition to the SDC rules. Other things they might look at when considering your status is, do you provide your own equipment? Are you taking the financial risk? For example, if you do defective work, do you have to correct it at your own cost? How are you paid? Are you paid hourly or by the contract? Are you providing your service exclusively to the client, or can you work for anybody? What is the intention of the parties? And finally, if they took a step back, do you look like a business? This is just a few of the questions. So even if you were caught by IR35 under the old regime, it was probably still a better option than being directly employed, because you got your 5% deduction, which is just a deduction for the general cost of running a business. You deduct your travel and subsistence and other costs. Now you can no longer do that. So what do the changes mean for contract workers in 2016? Well, realistically, the government suggested that if you really needed a temporary worker, you'd pay them a higher rate. Sadly, that hasn't happened. So it means a reduction in profit and also a significant increase in the risk of error and HMRC penalties for those errors. So if you are providing your services through an intermediary, it's likely that you can no longer benefit for the tax relief on the travel and subsistence expenses unless they fall outside of IR35 and the SDC rules. So what's the solution? Well, as far as personal services companies are concerned, they should check their contracts and working practices and make sure they're regularly reviewed. And this isn't just their contract between them and their company, it's the contract between them, their company, the agency worker, if there's an agency involved, between the agency and the end client. As Origin's partner, TT Intelligence can obviously offer this service, and we will offer that at a 10% discount on our normal fees to anyone that comes to us through Origin or through this webinar today. If personal service companies are no longer suitable for you, you could simply become self-employed. If you pass the status tests, then there's nothing wrong with that in theory. Or if you've had enough of it, you can just become an employee, or you consider other options, which I think Craig will probably talk you through later. Just one final point on the personal service companies and this SDC. If the personal service company is involved in something called a managed service company, which I'm not going to go into right now, then you don't even consider SDC. You simply can't have travel and subsistence costs. And this is a bit of anti-avoidance legislation that was put in at the last minute. Unfortunately, when the revenue drafted all these rules, they've now had to admit, rather embarrassingly, that they've got it wrong. So
Brilliant.
what they're trying to achieve here, they're not achieving in the current drafted legislation. They're simply going to update it at the earliest opportunity, but they think in the majority of cases, what I've said here is going to stand. The press are widely criticising them for this because it's suggested that they're trying to implement overly complex legislation in too short a period of time. To make matters worse for them, an independent review of the contractor market, the personal service company market, says that contrary to their statement that 90% of personal service companies are non-compliant, actually 90% are compliant. So the revenues numbers are flipped on their head. And really the question's got to be asked, if that's the case, are the changes really necessary? And what's more, are they cost effective to the taxpayer?
I think, James, sorry to interrupt you, I think a lot of this is about self-policing. So they put the onus on both the worker as well as intermediary and the client. Would you agree on that?
No, you're absolutely right, Greg. Yeah, that was going to be one of my final points.
Okay, fair enough. Sorry for stealing that.
Yeah, move on to Okay, so another thing that's changed in the personal service company world is IR35 and public sector workers. From April 2017 and following further consultation, which we expect in the summer, the public sector bodies who engage personal service companies will become responsible for policing IR35. And if they get it wrong, they'll be responsible for meeting the loss of tax as well. Well, if it's not recoverable from the personal service company for whatever reason. Currently, it's just the personal service company's responsibility. If there's more intermediaries in the supply chain than just the public body and the personal service company, then it's the entity involved that's closest to the worker. HMRC has that they will assist the public sector and the workers with their objectives, with meeting their objectives under the test by producing new guidance and new online tests. Some guidance has been produced already, but the online tests aren't yet there to the general public. They have said that in the more complex cases, they will provide a real-time view, real-time review of the working arrangements and give an opinion as to whether the work is caught by IR35 or not. Services outside of the public sector are not currently affected by the changes. However, it's widely considered that this is just this is a guinea pig, a sort of a test, and if it works, they'll roll it out into the wider public later on, maybe next year.
Yeah. Question, James. What is a public sector body?
Well, I mean, the guidance note had a load of bullet points. It basically suggests that it's government departments, armed forces, local government, NHS, schools, higher education institutions, the police, and then other bodies listed in a schedule, which I've not been able to locate, but it says it includes the British Museum, the BBC and Channel 4, and also other companies that are controlled by the Crown, for example, the Transport for London. So it's quite a big sector that's going to be affected by this. In fact, the public sector are one of the biggest engagers of temporary workers out there. So
I think it would have been easier just to tell us who isn't affected.
Absolutely.
Thank you.
So the new dividend taxation regime, which was announced last summer, has the effect that the dividend income will be no longer grossed up for personal tax purposes. Previously, if you received a £100 dividend, it was shown on your tax return as gross income of 111 quid with a tax credit of 11 quid that effectively paid your tax liability if you're a basic rate taxpayer. That's been abolished from April the 6th, and a new dividend tax allowance of £5,000 has been introduced. Any dividend income above this first £5,000 is taxed at your marginal tax rate, but the £5,000 tax-free amount eats up your basic rate or your higher rate tax band, so it still counts as income, it's just taxed at 0%. Dividends after that £5,000 will then be taxed at 7.5% in the basic rate, 32.5% in the higher tax rate, and 38.1% at the additional tax rate. At the same time, we've got a new personal savings allowance, which again, because many personal service companies are paying themselves a minimal salary, may actually be beneficial for personal service companies. If the company owes you money, which is contrary to a lot of situations, admittedly, then you could pay yourself a healthy rate of interest on that balance. Your company would get a deduction, and you would receive the money tax-free. So it's in fact better than dividends. This new personal savings allowance is for savings income only, but excluding dividends. Next. So what actually happens with directors' loan accounts going forwards? Well, directors' loan accounts is a problem for smaller companies with just one or a few shareholders. There's a technical term called closed companies, but we won't go into that. What often happens is directors and shareholders of these smaller companies often draw out cash from their company without declaring dividends or salary. And the accountant comes along at the year, tries to reconcile that and put in place sufficient salary or dividends to actually counteract that. But more often than not, the director becomes overdrawn, effectively owing the company money. The revenue see this as a potential to avoid corporation tax and personal tax, so they effectively ask the company to pay what is essentially a temporary tax to HMRC. This temporary tax is payable on the amount of the loan that's outstanding at the year end, and it has traditionally been paid at a rate of 25%. That's payable on the normal due date for the corporation tax, which is 9 months and 1 day after the end of the company's accounting period. There's a proviso that says if the loan has been cleared by that date, then the payment is not due, which is why accountants run around frantically at the 9-month point after the year end trying to get things sorted. If the balance isn't cleared and this temporary tax is paid, then once the loan is cleared, however that may be, then the company gets this temporary tax back 9 months and 1 day after the accounting year in which the loan is cleared. So this can be quite a significant timing problem, generating cash flow problems for many companies. Further, actually, to get a repayment now, they introduced a new formal repayment claim about a year ago, so you have to formally reclaim it as well. It doesn't just automatically come back. There's complex anti-avoidance rules regarding repayments. From the 6th of April this year, the rate of tax on the loan balance has increased to 32.5% instead of the current 25%. But the new rules only apply to debts that arise on or after the 6th of April 2016. So if you haven't got a tax year, so if you haven't got an accounting year that ends on the 5th of April 16, as almost no companies do, then your tax calculation could get quite complicated this year. Usually, the loan advance will be cleared by either repayment, declaration of dividend or a bonus by the accountant, which strictly shouldn't be backdated, but unfortunately there is a widespread abuse of that in the system, or by actually writing off the loan. If the loan is physically written off, then the director shareholder is taxed as if they'd received a dividend, and Class 1 national insurance, both employers and employees, also applies to that write-off. Although, again, the accountancy profession has many arguments with the revenue over the year that employees' national insurance shouldn't apply. But there is also a fourth option for clearing the balance, and that's where the direct shareholder has an asset of value that can be transferred to the company in satisfaction of the outstanding amount. As long as that's done correctly, then HMRC have to repay the temporary tax as outlined above. Okay. There's many traps within the legislation that must be carefully circumvented or navigated, such as the new bed and breakfast rules that were introduced probably about 2 years ago. The bed and breakfast rules say if you clear the loan account and within 30 days pull some money out again, then that money that's pulled out is essentially deemed to be the money you've just put back in, so it's ineffective. And what's more, if the revenue say that you pay the money off and then let's say wait 60 days and pull out the same amount of money, if they think there's some sort of arrangement, they can again ignore that repayment and not repay the temporary tax to you. So you've got to be very careful there. Obviously, TT Intelligence has got a number of options to facilitate clearing the loan balance. And what we can do is we can review your individual situations if you need to, prepare a report of the options and costs, and help implement the clearing of the loan and getting back or removing the temporary tax liability. If you need any help with that, then please feel free to get in touch after the webinar with the contact details that were at the beginning of the slides. In addition to the new dividend taxation and the direct loan account, the revenue have also tweaked the starting rate for savings income and introduced a new personal savings allowance. We used to have a 10% starting rate for savings income. That was essentially abolished from the 6th of April 2015 and replaced with a 0% rate. This 0% band, this rate for 2015-16 and 16-17 is £5,000. Again, it's restricted by non-savings taxable income, ignoring dividends. So again, for personal service companies, if you have a small salary, then there is scope for receiving interest tax-free using this starting rate in addition to the personal savings allowance, which was introduced from this 6th of April. The interaction of these two different things that essentially do the same thing has caused much confusion, and there's actually misleading information out there in the press, and I've discovered an error on the ICAEW's, the Institute of Chartered Accountants, question and answer page. So even the experts are misunderstanding this. And it's not going to be, it's not such a big problem now, but when people come to do their tax returns this time next year, it is going to start causing problems. The new personal savings allowance is aimed at basic and higher rate taxpayers and depends on your total taxable income. In addition to these changes, the Revenue have realised that many people won't have any liability on their investment, on their savings income interest from banks. So banks and building societies will be able to pay interest gross without tax deducted from this 5th of April. However, if you've got a limited company and it's paying interest, as I suggested earlier, then the CT61 system, which is the system by which a company has to account for tax on interest paid to individuals, still exists. That's a quarterly return that needs to be done. And again, many accountants out there get that wrong, unfortunately. So the new personal savings allowance kicks in if the starting rate doesn't cover all the savings. To determine which rate applies, you have to decide what the other income is. If your other income, excluding dividends again, is less than £43,000, you've got £1,000 personal savings allowance. And if you've got a income of between £43,000 and £150,000, then it's £500.
I suspect that most of the people who are listening are going to be definitely in that bracket, the upper bracket.
Absolutely. Not forgetting the starting rate is up to £5,000. So again, that's being mixed up in the press at the moment. So, okay, moving on to company closure. This is an area where the Revenue has essentially tightened up on the anti-avoidance rules. Many accountants for many years have been recommended to people whose companies, be they personal service companies or proper businesses with multi-million-pound turnovers, to build up a cash fund in their companies, essentially money boxing, which is a term that's been bandied around, and then closing it down via liquidation at the end of its life and drawing out that accrued income, if you like, and subjecting it to a capital gains tax rate of just 10% using the entrepreneurs relief rules. Now they've decided that this turning it capital into income is too big a draw, and have decided to widen the transactions in security anti-avoidance rules. So from 6th of April 16, the existing rules have been widened such that they now also apply to repayments of share capital, distributions on liquidations. It includes the repayment of share premium accounts and payments to associates of the shareholder director. There's new time limits for applying this legislation. It used to be 4 years. Now an inquiry has to be raised within 6 years, and a notice of counteraction can be issued at any point. That used to be just 6 years as well. So this is quite a widening of the rules. In addition to extending the transaction in securities rules, they've also introduced their new phoenixing rules, which says any sort of if there's a distribution in a winding up of a company, be that informal or liquidation, and anyone involved who benefits from a distribution continues to be involved in a similar kind of business, the same kind of business, within 2 years, then that capital distribution will be flipped into an income distribution.
A lot of company owners do like the idea of phoenixing.
They do. They do.
And then carrying on hoping that, oh yeah, no problem, I'll set up my stall again and carry on as they did before. And
that's exactly what they're trying to stop. And if you're caught by these rules, it could effectively turn a 10% tax charge into a 38.1% tax charge. The Revenue have confirmed that they're going to rewrite the legislation, because it came out in draft legislation, in a consultation document in November, I believe, and they have said they're going to update the legislation such that it won't apply to minority shareholders or genuine commercial transactions. But that has not all been defined yet, so we're waiting to see what happens next on that one. So landlords, the taxation of landlords has changed wildly over the last few years. And the first thing that changed in April 2003 was the withdrawal of relief under the renewals basis for unfurnished properties. This was essentially an extra statutory provision the revenue allowed that said if you replaced fridges, white goods, carpets, although there was no statutory relief for those, they would allow you relief for them. So if you've replaced in an unfurnished property fridges, white goods or carpets since April 2013, and you've claimed a deduction on your tax return, then your tax return is wrong. And again, when this was announced, those in the know saw this as a simple exercise to round up landlords and apply penalties and additional charges on them. There is a new relief coming in from April 16, which I'll mention in a moment, where relief becomes available again. So this was just a 3-year window where you could get no relief for that. From April 2016, there's an additional 3% SDLT charge applied on the acquisition of residential properties if it's a second residential property for an individual. At the same time, well actually 6 days later, there's also been the withdrawal of the 10% wear and tear allowance, which is for furnished properties, and the renewals basis for furnished properties. They have, however, introduced a new replacement of domestic items relief, which gives a similar effect, but it's far less generous. Essentially, from the 6th of April this year, whether your property is furnished or unfurnished, you can get relief for the replacement of furnishings, white goods, carpets, that sort of thing. The new SDLT charges I mentioned only applies if you own 2 or more residential properties at midnight on the date of the purchase of the second property. There is a relief if you're replacing your main residence, but often nowadays people will acquire a second main residence, not selling their first immediately and sell it sometime later. As long as you sell your original residential property within 18 months, then you can get a refund of that 3%, but you do have to initially pay it, unfortunately. In the consultation document which proposed the 3% charge, it was suggested that there would be a relief for larger property businesses, whether they be rental or property developers, but they decided ultimately that that was not necessary, that these businesses did not need any relief from this 3%, so they are also subject to this. As I mentioned, companies are also subject to the additional charge, otherwise that would have presented an avoidance opportunity. But because an individual may already own a residential property, might buy a second one through a company, it applies to the first property that the company applies. From next April, April the 6th, 2017, a new finance cost restriction has also been proposed, which will be phased in over a number of years. And this restriction means that you can no longer deduct interest costs from your taxable income. You can't assume that this means that if you're a basic rate taxpayer, you're not affected, because if you're only just within the basic rate tax band and you're paying a significant amount of mortgage interest on your rental property, which is not uncommon, then loss of relief against your income for that interest deduction means you're now a higher rate taxpayer, and then your tax liability is actually reduced by 20% of the interest costs. The restriction will apply initially from 2017-18, and it will be 25% of the finance cost, rising to 50% in 18-19, 75% in 19-20, and it will be applying full from April 2020. There are some really complicated and fiddly bits to this, and as far as I'm aware from the tax software providers, they're a bit concerned about how they're actually going to make it work. There are ways to mitigate the effect of this through careful planning. which obviously T2 Intelligence can help you with. And the most obvious one is to acquire rental properties within limited companies. Obviously, you're going to be hit by a 3% additional SDLT charge, but as long as it's rented out to independent third parties, then the company can still get relief for the full finance costs. The problem arises, obviously, if you've got a big property portfolio that isn't currently in a limited company. If you wanted to transfer them all in, then there's capital gains tax issues and stamp duty land tax issues. So the additional cost of those can outweigh the benefit of getting them into a corporate entity now. So there are solutions out there, and obviously we have one. As I mentioned earlier, there is obviously from April 16 the new replacement domestic items relief. I don't think I need to say anything more on that, but just general repairs to other items in the property, again, like if you repair a sofa rather than replacing it, then the relief for that remains as it always has under general principles. So just moving on to other budget measures, the personal allowance has risen, well, will rise. We've got a typo in the slides there, I apologise. It's going to rise to £11,500 from 2017. It's currently £11,000. The higher rate threshold, that's the point at which you start to pay higher rate tax, is going to rise to £45,000 in April 17. It's currently £43,000. The Chancellor's frozen fuel duty for the 6th year in a row, which is apparently a massive giveaway, but it's really just not the increase of the tax. The corporation tax rate is going to drop to 17% in 2020, which is a very long way away, but we do like to pre-announce giveaways. It's currently 20% and is set to drop to 19% from 2017. The corporation tax loss relief is going to become much more flexible and much more generous from April 2017. Essentially, carry forward losses at the moment, whether they be from residential sort of rents or from trading income, can usually only be carried forward against the same source of income, the same type of profits. From April 17, you're going to be able to use carry forward losses against anything. They're also going to impose limits to stop larger companies exploiting these new rules. There's a new lifetime ISA for the under 40s, which kicks in from when you're 18. It enables savings of up to £4,000 each year, with an annual government bonus of 25% of your savings, which is almost the same as giving you a 20% basic rate tax relief on savings. You can use some or all of it to buy your first home as a deposit, or you can take it when you're 60. And if you really need the money that you've saved in the meantime, then you can get your hands on it. You lose the government bonus, and they take 5% off you, which they consider to be a minor charge. There's also a new Help to Save scheme for claimants of universal credit, which enables them to save up to £50 a month, £600 a year. And after 2 years, again, the government topped that up with a 50% bonus, which is slightly more generous than the new lifetime ISA, but it's a much lower number. The capital gains tax rates dropped to 10% in the basic rate and 20% in the higher rate, although residential properties are not included in this reduction, and the rates remain at 18% and 28%. The Chancellor extended entrepreneurs relief capital gains tax for long-term investors, giving a tax rate of 10% for gains on shares up to a lifetime limit of 10 million. This is for acquisition of shares after the 17th of March 16, which are held for at least 3 years before disposals. He also decided that some of the withdrawals of entrepreneurs relief he'd made back in December 2014 were a little bit harsh, so he's reinstated them and backdated them. Unfortunately, this now means that quite a few people who've completed tax returns for 14-15 have completed them incorrectly and need to go back and revisit them and claim the relief that they were initially denied. The stamp duty land tax for non-residential properties is also changed, as it was for residential properties, from a slab system to a slice system, meaning essentially it's almost like personal tax now. On the first £150,000, you pay 0% SDLT. Between £150,000 to £250,000, you pay 2%, and anything above £250,000, you pay 5%. Obviously, this is non-residential, so it's not subject to the additional 3% charge. A new micro entrepreneurs allowance of £1,000 for property income or trading income was introduced, which is pretty worthless, really. Essentially, if you have other income, other other sort of earned income from self-employment or employment, and you have a small amount of property income, or if you're employed, a small amount of trading income, then up to £1,000 can be received tax-free, even if it technically falls within the basic rate, the higher rate, the additional rate. The 100% first-year allowances for businesses investing in low emissions cars has been extended to April 2021. And finally, on the budget matters, there's a new sugar levy on soft drinks, which went down rather well.
I'll drink to that.
Absolutely. Moving on to sort of a final announcement, which has been announced in the budget, but it's by no means clear exactly how this is going to operate yet, is a new tax charge that's been proposed to apply on the 5th of April 2019 to any loans that are outstanding that have arisen from any arrangement that HMRC considers as disguised remuneration. Now, what they considered disguised remuneration was clearly defined in the legislation in April 2011, I apologise. 5 years ago, when it was introduced, it was quite clear that anything that had happened before 2011 was fine. They were making it clear that from April 11 onwards, they were having no more of it. Unfortunately, the proposed rules are now saying that the charge in April 19 will apply to any loan outstanding in April 19 that would have been classed as disguised remuneration occurred at that date. It's going to widen the definition of disguised remuneration and catch many loans. For example, the loans that arose in the Murray, aka Rangers case, which was a loan from an EBT. Essentially, that case is going to the Supreme Court in December, and there's many commentators who believe the decision which went in HMRC's favour towards the end of last year was utterly wrong, and hopefully the Rangers case should be won. The outcome of that happening with the currently proposed charge in April 19 is that even if a judge, and let's not forget that judges set precedent to make law in this country, even if a judge says that that was legal, it worked, it was effective, then the Revenue have sidestepped it by introducing a new tax charge in April 19 that means they'll get their money anyway. So it looks like many existing loans that you wouldn't currently think would be caught may well be caught by the new charge. This is clearly retrospective. We're waiting for the consultation with bated breath, and there are many QCs out there who are suggesting that this may well be subject to legal challenge because it's in breach of EU law principles. Essentially, the human rights section of the EU law says that you're entitled to certainty about your tax, and this is absolutely undermining that. So we'll see what happens.
Thank you, James.
So that's the end of my part. Anyway, so if you've got any questions, please feel free to start firing them through to Randy now. And in the meantime, I'll hand you back to Craig.
Thank you, James. That's all very good. You've just proved why it's so important to seek advice from an accountant or a tax expert like yourself.
Thank
you,
Craig.
Important. So I've got a couple of minutes just to explain to you, the listeners, and I'm presuming that you're all contractors, from April 2016, how you can remunerate in a compliant and tax-efficient way. Obviously, that's subjective, but these are the areas out there, if you go to market, that are available to you. So the first one's very obvious. Personal service companies have been around for a number of years. And of course, the government know that contractors are overusing these, and probably a large percentage shouldn't really be classed as self-employed because they go to the same place week in, day in, and so on. But they're probably the safest place to be right now. And what's good about a limited company is that workers can still use their travel and subsistence and certain expenses that they wouldn't be able to claim if they were employed directly. So that's an obvious way to go. And also, individuals with directors of companies with a lot of profit sitting in them can find ways to draw profit from them in efficient ways without spending lots of money, which Origin and TT Intelligence can provide solutions for. The next, somehow frowned upon, is anybody using some sort of PAYE umbrella. If you're not going to be employed directly, this is your next step, ladies and gentlemen, into ways to be efficient. What's happened with the removal of travel assistance is very much simply this. If you're going to go through an umbrella today, there's not a lot of advantage, because the only one that favours this sort of solution is, guess what? The recruitment agency, ultimately the employer, because they avoid paying employers' national insurance, leaving the poor worker to pay some of those costs.
Can I just interject as well?
Yes.
It's often the case in the temporary workplace market that these people don't want the obligation of being an employer either for employment law purposes.
Yes.
So it's not just tax here. It's employment law. They just don't want the obligations.
Yeah.
So people will still use these. They'll be forced into it.
Yes, absolutely, and it suits everybody to some extent, as long as the worker, you get an uplift in pay, which you're allowed to if you're going on an umbrella to cover all the additional costs, then you could argue it's a win-win. So that's one solution. The other on the market currently is something known as fixed expense umbrella, and that's where you could argue the contractor still has some genuine expenses. They're outside of SDC, so they may have expenses, say, for example, equipment or tools or training or anything else, even a mobile phone. If they are business-related expenses, then simply the umbrella deducts the average expense incurred by the worker, and that becomes a more profitable way to be. So those are called fixed expenses. We're almost there. We're almost coming to your questions. The other one, still allowable, which James has noticed in the legislation, and it's something we've often seen as well, is the fact that mileage is still allowed. If you can prove you have a temporary workplace, then why not utilise mileage to reduce your tax? So that's another way. And of course, the loan trust solutions that are out there, you can argue these are risky, but where used properly, and I underline properly, perhaps as a deferment tool, these are great solutions. So this, in a way, when somebody works with a trust or loan trust structure, they're on, let's say on 100,000, 20,000 base salary, £80,000 loan. Some of these people obviously looked at, but if dealt with correctly, they offer still a good solution. But it's eyes wide open contractors out there, not eyes wide shut. Lastly, hybrid PAYE solutions are geared more towards the lower earners, blue-collar workers, but they are still an option, and there are a number of umbrellas providing these unusual but compliant solutions. And last, something that's been around for hundreds of years and came back in the 1940s and 50s as companies needed temporary workforce, and as more work came into play, people have taken on the role of sole trader. It started in the 70s, SC60, into the 80s and 90s, 714, and in the construction industry now they recognise something called CIS, where tax is deducted at source. Or if you're an IT contractor and you believe genuinely that you fall outside of SDC, you can still be paid gross and avoid the employer's national insurance and just simply conduct a tax return on a yearly basis. So those are the legal ways you can still remunerate and be paid. I've come to the end of my part. I think James has probably covered a lot of his. We don't want to bore you too much, so this is a good time to throw your questions our way. Otherwise, we'll just ramble on about some other tax issues. So I'm just going to drop down the chat bar here and see if there's anybody has any messages. Just throw your questions out there. We're waiting for you.
Mm-hmm.
Sounds rather ominous.
Yeah,
I don't know whether Randy can still talk. Randy, can you field some of the questions to us via the email or via the text? Because I can't actually see any here.
Yeah, one question is here, like, is this about like travel and subsistence? Like, you say is applicable for limited company. So I think you pretty much answered the same, but you can talk more about
Randy,
limited companies.
Yes. This affects limited companies as well, personal service companies, if they are caught by IR35. If they're not caught by IR35, then you don't have to consider SDC at all. So if you're not caught by IR35, you can continue to receive your travel and subsistence payments tax-free. So the company would effectively invoice the end client to include the travel assistance costs, and that strictly would be taxable income for the actual company, but then the company would claim a deduction for the travel and subsistence payments it makes tax-free to its worker, if that makes sense. Am I making sense?
No, that makes sense because the director is usually employed and pays himself a salary.
Absolutely. So the director then receives his basic salary, which is taxable, but obviously at the right level you pay almost nothing. Then he receives on top of that a non-taxable payment for his travel and assistance costs, and then he is remunerated via dividends or via any other solutions on top of that.
That's fair enough.
Yep.
Randeep, any other burning questions out there?
Yeah, there's questions are coming. So Lalit Kolai is asking, by trust structures, do you mean EBTs or something else?
Yeah, I can answer that question. Trust structures are, yes, usually where there's an employer involved, usually a UK entity representing the worker, employing them usually, which is absolutely fine. And then there's a trust, usually, I guess, if you like, employs the worker, makes the salary, and makes the loan payments to the worker, because obviously there has to be, I guess, some offshore element because of the compliance. If it's solely UK, you can argue it wouldn't work. But where the offshore element is approved and there's QC backing, which all of them must have, and it's worth scrutinising this if you're using one of these schemes to make sure who the barristers are and do they have written, this is very important, enough in writing to back up the trust, then there's no reason why it can't work. I think there are a lot more people being looked at now with these sorts of trust and loan structures because the loan element in some cases is being deemed as a benefit in kind or a salary, if you like. And of course, there are cases where they're having to be defended. And I mentioned about eyes wide open earlier, because loan structures, while still compliant and quite tax friendly, it is, into some respect, is better to have options where some of the income is put aside into investment where it could then be untapped to contribute towards any potential liability of tax. But there are a number of people that do these things for years and there's no issue.
Okay, thank you. There's one question from Stephen. It says, someone said a mix of limited partnership and limited company would be good. So 5K dividend from limited, rest from LLP. Have you heard of that combination?
I'll field that one. I've seen things being offered out there on the market where you route some of your money through limited companies and some through LLPs. And in principle, it is possible to do if you have distinct services being provided through your limited companies that are different to the services you're providing through your LLP. But in most cases, it's going to be very difficult to do unless you get all of the contractual obligations correct, which will probably involve a solicitor, hand in hand with a tax advisor, hand in hand with the end client agreeing to all of this, of course. So yes, it is possible. In fact, the Revenue's own manuals does dictate that just because you've got a limited company doesn't mean that you can't be providing your services in the same in a different capacity. So difficult, but possible, yes.
Okay. I hope, Stephen, you got the answer. And let me know, guys, if you want, I can unmute as well if you really want to speak out. So just raise your hand, I can unmute and you can answer. You can ask a question. That's the one way. And there's one question from Lester. Says, will the presentation slides will be available afterwards? So we are recording this session. So if you need recording, that will be available about the slides. Craig, it's up to you.
Yeah, absolutely. We can send the slides if you want them, lock, stock, and barrel. Although I think the audio is probably the best bit. But yes, or obviously they can get in touch with us via email at Origin Wealth, and it's on the slides actually. I think it's on the first. I think it's info@originwealth.co.uk is our general inquiries, or you can contact me directly, craig.moss@originwealth.co.uk.
Or also the TT Intelligent contact details are also at the beginning of the slide. You can just click the links on that. Well, you can't click the links, but you can copy and paste it.
Exactly.
And okay, any more questions, guys? I think we have some confusion. Like, so Lester, you want to ask something? Shall I unmute you? Like more? Because I think you raise your hand, so I'm not sure. Okay. Okay. What about Maria? You want to ask any question from Future Link Group? Shall I unmute you? Okay, I'm doing. Okay, nothing happening. So that's it. Looks like no more questions. And guys, I have sent the link again. I'm reminding, like, this is a link for LinkedIn post I've shared. So make sure you like it and whatever you feel like, because that's the way we can promote it and it can go to wider audience. And again, I told you, like, there's a secret prize if you get a maximum views on the shared post. And feel free to connect me on LinkedIn. And I'm seeing there's no more questions are coming up, so I should conclude it over here. And thanks a
Well,
lot.
just before you do that, then Randy, because I can see people are leaving now, I'd just like to thank everyone for listening to myself and to Craig tonight, and I hope you found it useful.
Yeah, likewise. I've enjoyed talking to you all. I didn't hear anybody back, but
Yeah.
I can imagine you're a great audience, and we love the questions. I know tax is quite complicated, and it's not the most exciting or what I would call sexy side of anybody's life. But you know what? It's out there, and you've got to deal with it. And a lot of people put their head in the sand. So thank you very much for hosting this, Randy. I really appreciate it.
Thank you, guys. This is a small accolade from me. Thank you, guys.
I love it.
Very good.
Yes.
Thanks, Randy.
Bye. Bye. Take care. Good night. Take care, guys. Thank you. Bye.
Bye.
Bye.